Good morning and welcome to Orlando Real Estate Buzz. It was you still standing, Jim?
Uh,
I mean,
maybe. I'm not sure. I'm not sure of
it
anything
has
anymore.
been quite the morning. First off, GDP just swung and missed. Just absolutely missed. Treasuries are getting crushed. And there's a good chance we may be back at the 8% mortgage rates again.
Yeah, it's looking that way.
So good morning. We're going to dive into it right away. And, it was just tough morning to wake up and wait for those economic reports this morning, weren't they?
Absolutely. And the very first one I saw was the GDP. Huge miss compared to what everybody was expecting. I was thinking, awesome, right? That's going to help our bonds. It's
Yep.
going to help our rates. But everything that came with it, oh man, did that stink.
Oh, yeah. Yeah. Because they were expecting someplace, I think, around 2.5. Some people said
2.5.
as high as 2.9. And we came in at 1.6. That's like a snail's crawl type of GDP number,
Right.
And you're right. Naturally, I saw that and I'm like, oh, relief. It's working. It's finally starting to get absorbed into the economy. Everything that Powell has done, the philosophy of holding higher for a little bit longer is starting to pay off. And then you just kind of start reading the details. Yeah, the details.
Those
Excluding
darn
food
details.
and energy prices, the PCE, that's your core price index, increased 3.7%. They were expecting 3.4. That is inflation. It's still here and it is not going away.
No, we are stuck with it, and it's one of those things where you're looking at the inflation numbers are giving us today. Obviously, the month-over-month PCE numbers come out tomorrow, but there's a lot you can
Yep.
infer from what they gave us today, and I mean it sounds like it's going to be not pretty. Whether it's upward revisions last month or just a terrible number tomorrow, one way or another, it surprises the markets, and that's why we're seeing what we're seeing this morning.
Yeah. And it's kind of interesting because I was looking at the tracking for the Fed. This is something we look at every week, and this is kind of misleading because before the GDP came out this morning, Jim, we actually had about 2% of the people saying there was going to be a rate increase in May. And then the GDP number came out and boom, this came up with 6.4%. But at least some people are reading the report and looking at the inflation numbers, and they're saying no price cut. And I think you were saying you were reading something that you don't see the first one to when, December?
They're saying December, yeah. Using the same tool, the first cut isn't fully priced in, right? Isn't at least probable until December at this point, which obviously just 2 months ago people were saying May, right? Which would be next week.
Yep. And that's not there. And then you go into June, and again, you're looking 90% of the people are saying we're not going to have a rate cut in June either. I just think the realization why we're not seeing it in the stock market. I mean, the Dow got smacked nice and hard this morning, about 400 points, somewhere in that area.
Yeah.
But you're not seeing the pullback that I would expect when you can see this continued inflation number in the stock market.
And I do think that's still coming to some extent if the the 10-year yield stays where it is, because it seemed like for the last couple of weeks we were back to that tale as old as time where stocks, especially tech, was really responding to what rates were doing, and you were seeing on days where the 10-year was moving up 5, 6, 7 bips. that those were the big red days that we were seeing. So,
Yep.
if we are in a situation where, yields are going to be sustained at this level for a time, I do think that's going to take the legs out of, the crazy, crazy equities run that we've seen for the last, 6 months.
Yeah. Yeah. You ready for it? This is going to hurt.
I don't want to see it.
This one hurts this morning.
Yep.
Look at that. Look at that. We're currently sitting at 4.725.
Yeah, it's interesting.
We had jumped, we had held for so long in that 4.2 to 4.3 range. Rates had settled in, 7, a little bit below. You could catch it on a good day, a little bit below. And you kind of saw numbers start to increase a little bit because I think people started realizing, hey, this is kind of where we're going to be overall. And then we took that jump to that 4.5. So we jumped 7.25, some days 7.5. And this is just gonna hurt. I mean, we're probably gonna be 7.75 with lower credit scores. You could be back in the 8s again.
Absolutely. Yeah. If you're not willing to pay points, you're definitely, you're looking at the 8s at this point for a lot of borrowers.
Yep. And it's just, I know what happened back in October when we kind of hit this very similar level. I mean, it stopped. I mean, the phone stopped ringing when we, and I tracked my web volume, and every time you see that quarter point increase in the interest rates, I've seen a very large cut in the volume on my webpage.
Right.
Because people are losing so much buying power. And it's interesting because, I work with a couple different lead services. One happens to be Op City, and everything coming in from Op City is $300,000 and less right now. And what's sad is I understand, because it's probably with the interest rates, that's where a lot of people are stuck qualification wise, but then there's still nothing out there.
Right.
My question kind of is, are we going to see that price break? When are we going to see that price break? What's going to break first? Is it going to be the interest rates, or is it going to be the prices, do you think?
I think that it is going to be the prices. Obviously it depends on, not even just the state, but the area, right? Like, certain areas that were really, really, geared towards, people with second homes, people with Airbnbs, that kind of thing. You're seeing a lot, the velocity of listings increases is higher there, right? Like the change is higher there. It's not just the level of the number of listings, but the rate of change of those listings, because that implies that people are running quicker, right?
Yeah.
And when you have that, especially coupled with rates that are rapidly increasing and buyers that are standing on the sidelines or even moving off the sidelines, not even interested anymore, like that's what I see as, like, that means prices have to fall eventually. And with those inflation numbers this morning, I don't see the rates declining, anytime soon.
Either do I. And we're seeing levels of increases in price reductions, but I don't think we're seeing them at the level that we need, because I mean, what is it? About every tenth of the point? How much do you lose? About $10,000 in purchase power somewhere in that area?
Yeah, around there. Depends on the
So, I mean, really, in the past month, someone who was qualified at 7%, say at $400,000, is now sitting about $320,000, and that takes you out of a lot of homes, at least in the Orlando market, because our median is sitting in that 425 range. And you've seen the increase in the days on market. You see the increase in inventory. Condo market's just a disaster, complete disaster.
Absolutely.
But people are going to start start looking at it, like, why is my house selling? Why, you told me this is where it should be priced. I was like, well, yeah, we priced it when it was at 7, when rates are
Right.
at 7. When, you know, we've just lost a good portion of our buyer pool because rates are now going to be sitting at 7.5. So people who could afford your house at 400,000 can now only afford a $350,000 house.
Right.
So
And to your what you were talking about with setting expectations and prices with sellers, it's really important when realtors are doing that, because setting that up front, it prevents what I would call a disorderly exit. What you
Mhm.
don't want is people all of a sudden seeing, okay, my house isn't selling, let's start rapidly slamming on price cuts, and then everybody does, right? Then it happens
Yep.
very quickly, right?
Yep.
That's why it's like, setting it correctly up front
Yep.
will make things better for everybody, if that makes sense.
Yeah. One thing I'm going over with my sellers now is actually going back and historically looking at where the rates were when the comparables sold, because we've had such swings in the past year. You kind of have to, okay, look, when rates dropped to 7, these houses sold and this is what they sold at. When the rates came back up, you notice that these houses were staying on the market when they kept the prices the same. But when they dropped them, 10,000, 20,000, now they sold. And you got to think of it that way, because it's a fact of life now, in that tenth of a point in an interest rate can actually kick someone out
Right.
of qualification.
And that's a great way to look at it, because on the buyer side, it's not just houses. Everything in this country is what is your payment, right? Like, when you're
Mhm.
buying a car, they don't try to get you to focus on how much you're paying for the car. You're focused on you're paying $500 a month, that kind of thing. I mean, it's very similar when buying a house, but when you're selling something, you're focused on the top figure, right? You're focused on what the asset's going for. So to open up the seller's eyes a little bit, to be like, okay, the payment is what matters here to the person on the other side of this
Yep.
transaction, is something that I wish a lot more people would do.
Yeah, and there's so many factors now, and second biggest one, quite honestly, are insurance costs in Florida.
Yeah.
With insurance costs doubling and tripling, you got to remember that that's all taken into your payment now. So where we used to budget, $150 a month in the payment, we're doing $350, if not more, a month in the calculation of the payment. And that again cuts down the buying power of our clients. So there's, for sellers, they've got to realize, hey, there's a lot of headwinds to your buyers. And if you've got a buyer coming to you, sometimes creative solutions have got to come out. I I was telling you about this a little bit earlier. I'm starting to get really miffed at the agents who are out there saying, "Oh, buy the house, date the rate. Buy the house, you can just refinance." You know, one agent's like, "Oh, you think things are crazy now? Wait till they're 5%." And I told her they're not going back to 5%. Not happening. She's like, "Oh, we'll never know." Like, yeah, if you actually understand any type of economics, you would know. And you need to know, because you need to convey that to your clients that,
Right.
hey, we're going to be stuck here for a while.
Yeah. We
And
were in
so
that era of very cheap money, and that's not the normal. That was not the normal.
it was never the normal. It was actually never the normal. And you look, I mean, historically, we're probably in the median range of where interest rates have been for homes.
Right.
And it's just people just like, oh my gosh, it's so expensive. It's like, well, historically, no. But the difficulty is, historically, prices have never been this high.
Right. It's that
So,
combo of high price and high interest rate that really
yeah,
makes things hard for a buyer.
yeah. And the thing I've been seeing, and I was reading about this the other day, and I'm starting to look this. I want to see what they look like. Is all these build to rent properties? With what's going on with these? We've got one here in Altamont, and nice house, nice looking house, $3,400 a month. But then you start calculating, okay, if I bought a house at $400,000, taking the taxes, taking the insurance, and it's like, ooh, I'm at $4,000.
Right.
That 3,400 doesn't look so bad.
No,
you
it
know
doesn't. And I mean, historically, that or at least the last 10 years, that spread has been the opposite way, right? Like you've actually
Yeah,
been able to save by buying as
by
opposed to
buying.
renting. But right now that it just isn't working that way. And I mean, some people have used that as a reason why prices have to come down, right? Because ultimately there has to be an incentive to buy, otherwise you won't have buyers. But I
Yep,
mean, it's certainly, if that is true, it is definitely a slow moving ship.
yep, yep. And I just I don't see anything out there right now that's going to change.
No.
That's going to force us, unless we get a total collapse, and they've got to cut them. The soft landing, total myth.
Yeah.
Never
No.
been one. Never
Not
will be
not a
one.
chance. Not a
Not
chance.
a chance. I
Everybody
think.
always says it's soft landing until it's not.
Yeah, yeah. I think when it hits, it's going to hit us hard, and it's just being ready.
Yeah. And
Maybe you do
that's
have to sit on the sideline for a little bit.
right. And it's unfortunate, obviously, as real estate professionals, like we don't want to see that, but also, you have to be realistic. Um,
Yep.
but to the point of the GDP coming out at the same time as the quarterly PCE, there is two sides to the Fed mandate, right? Like their
Yep.
mandate is the 2% target of inflation over time, as well as sustained employment in the
Yep.
U.S. So if we start seeing the GDP end really slowing down, the unemployment numbers have been oddly great.
Yeah.
A
They
lot
they
a
came
lot
out this
better.
morning,
They
and they were
did.
flat.
Yeah,
They were
basically the
absolutely
exact same
flat.
as they have been for the last 3-4
Yeah.
months.
Yeah. I
Um,
mean, within 5,000, it's like, hmm.
right. But there's
Yeah.
there's there's a lot of reasons people are not so much trusting those numbers anymore, right? It's I mean it's hard because it's very much anecdotal versus versus the BLS official numbers. It's hard
Yeah.
to take the anecdotal evidence over that, but from talking with people, like people that are on the job market are really struggling, especially white collar
Yeah.
jobs.
Yeah. Yeah. And it's a lot of the high end people
Hmm.
who are actually the ones getting laid off.
Yeah,
I mean, Meta came out with their numbers. Was it yesterday?
last night.
And they
Yeah,
look great, but what nobody remembers is they did what, 10,000 layoffs
yeah.
last
Their
year.
tech layoffs last year, even first quarter, have been pretty much across the board, and huge in numbers, just
Yeah.
absolutely huge.
Yep. So
And those are big, well-paying jobs,
yeah.
that will trickle down into local economies, right? If you lose a $300,000 a year job, or if you lose 300,000 a year jobs, that's going to
Yeah.
hurt a local economy.
It's gonna hurt. It's gonna hurt a lot. It's gonna hurt a lot. Well, let's hop into our Orlando numbers. Show you what came up this past week. Numbers stay kind of flat. We 449 homes. It's Orlando's been very consistent in that 400 mark. Um, Good jump in inventory. We actually broke for the first time that 6,000 unit mark, which we haven't seen that probably 2 to 3 years now. Somewhere in that ballpark. Condos, I mean, they're just in the doldrums. 146, not moving anywhere. Inventory continues to increase overall. And then when we look this months of inventory, we're holding at 3. As I talk with Joe, 3 months really these days is kind of a buyer's market.
Yeah.
You know what I mean? It really is. And then this I found interesting. I was looking at the short sales. Look at the 300 to 400,000 market. 6 short sales. I can't remember the last time we saw that. But
Yeah.
you know who that is? That's the people who have bought over the past 2 to 3 years and have to get out of their house.
Yeah. People who thought
And
they could date the rate and refi in a few
yes.
months.
Yeah. And you know, because the first 13 and a half years, you don't pay the amount of interest you pay down is nothing.
Mhm.
So they've bought a lot of these new homes in developments that are still being built. You got a builder offering 4%, 5% interest rate for the exact same house that's brand new and yours is now 2 years old.
Yep.
You're in trouble.
Yep.
I got one that we just listed in Winter Haven. A friend of mine actually just listed in Winter Haven that the gentleman bought it 2 years ago, and the exact same house they're still building. You can get it for $330,000, and he still owed $322,000 on it.
Dang.
We're short selling it.
Right.
There's nothing.
That's the only
There's
way
no
you
other
can.
way. There's no other way we can get rid of it. You know, unless he wants to go into foreclosure. And we don't want to put him through that. You know. And then the original list, the sales price, this has been holding right about that 95%. So there's always room. And again, you know, we saw this tick up a little bit, but the over $1 million, you're getting some absolutely huge discounts on over $1 million.
And
Our
that
days on
4.5
market,
month supply. Wow.
yeah, yeah. Our days on market is starting to creep up again. And now I think it's going to go. I think we're going to shoot back up to that 60 to. We may go up to as high as 70 days. I think, with where rates are headed, because that's what we saw in October last time. And then you just see, you know, weekly sales really a little bit above that 400 mark consistently since about the end of February. You know, this really kind of runs a 30-day lag. So it'll be the end of May where I think we're gonna see these numbers drop back down to like we saw here into the 300s. You know, hopefully we don't see this like beginning of or the end of the year and beginning of January where they were, you know, just over 200.
That would be scary. That would be
Yeah,
definitely
that would not be good. And then our inventory just there's people who want to sell, people who've just waited and they're putting their houses on the market, you know, trying to do the best they can. So you see our inventory has grown just over 11% since January. And we finally broke that 6,000 unit mark. So for, you know, if rates weren't up, I'd say to a buyer, we really got an advantage right now.
absolutely.
But I really think this is where we've got to start, you know, really start crunching numbers for both the buyers and the sellers. It's like, if we're going to do this, give them, you know, let us work with our mortgage guys and get an idea. Hey, to buy down the rate 0.5%, so these people can afford these houses. You know, what's it going to cost? You know, be ready to pay for it. You know,
Right.
because you know it actually, I've done some calculations side by side. If you can get someone down 0.5 point as opposed to a $10,000 discount, that 0.5 point is a heck of a lot better than that $10,000 discount that you're going to get.
Especially at those higher prices. Absolutely.
Yep. Then hopping into our condos, you see here that, you know, original list sales price, we're sitting at 95% again. But this, I think, is more again is to do with the prices that are coming out are a lot lower. And then you see our months of inventory still holding very high.
Wow.
You know, 4.7 buyer's market, absolute buyer's market. I'm actually looking at some for investor this weekend. And for the first time in probably a year, I've got 5 units. You know, they're just ones, but 5 units under $150,000
Wow.
that we can actually look at.
Yeah.
I can't tell you the last time I had that. They started pushing the ones up to 175 to $200,000.
And honestly, the anecdotal, of course, but I've been seeing that the lower price stuff has been, moving the quickest still, right? Well, I guess not quite anecdotal, right? Like according to your numbers, it's a
Yeah.
very similar thing. So the idea that even those lower level ones are starting to have to move down, that's something. That says something for sure.
Yep. And then you just see our weekly sales. I mean, you think of the size of Orlando. You got to remember this also includes vacation rental condos. These numbers, and there's thousands of those. And you're averaging 119 per week. That's sad.
Yeah,
That is
that's
not good.
incredibly low volume, and that's scary, right? Like when you're looking at rapidly rising supply and demand that is already low and probably going to go lower with the rates, like that.
Yep.
You know, it's a very different picture for a
Yeah, and
seller right now.
they're hard enough to finance to begin with because generally, you've got to go through that review. You know, a lot of times it's going to be 20, sometimes 30% down that you got to put on these.
Yeah,
So,
yeah,
and they're
condos have definitely been harder to finance over the last
yeah.
year
I
and
mean,
more.
I don't think we have one FHA approved condo in Orlando anymore.
I
I
believe
can't
it.
think of one.
I believe it.
Then you just see our inventory. Inventory is up 20% since the beginning of the year. So, I mean, condo market is just very tough market right now. So those are our numbers for the week. Jim, thank you for joining us. It's always a pleasure to have you on.
Happy to be here. Thanks for having me.
Yep. And we'll take care and we'll see everyone again next Thursday. Have a wonderful day.
Thank you.